There, it is Ashley with Keller Williams Real Estate in Everett, and I am here with Tyler Beard of Cross Country Mortgage, and we're here to talk to you guys about how much money you need to make to buy a home. I mean, it's like the $1 million question, right? So
it is. You always get the call, hey, I make XYZ, how much can I approve for? What do you think I could buy, right?
Exactly. So we're going to go over a couple of examples today to give you an idea. So there are some like assumptions built into this, and Tyler will go over those, but then you can just get a rough idea of what it takes to buy a house.
Agreed. Yep, I absolutely agree. So again, this is kind of like more informal for Ashley and I to be going over some of these numbers. And obviously, if you want to get approved, you're going to need to reach out to us directly and look at your exact scenario, because what we're going over today are just ideas and thoughts on what people may need to make. But in your situation, it could be higher, it could be less. It just comes down to other factors that we're going to go over. Correct. So Ashley, why don't I go ahead and share my screen? Yeah. And then what we'll do is we'll talk about 3 different price points today. We'll look over $300,000 for a purchase price. We'll look at $500,000, and we're going to look at an $800,000 purchase price and a couple of different down payment options with conventional financing.
Yes. And so that's really important to remember. He's just looking at conventional financing. All the other ones would be completely different. So.
All right. Can you see my screen?
Yeah, I can see that really well.
Perfect. So let's talk about conventional financing for a second. The reason we're looking at conventional financing, it's a simpler loan in regards to, I always call it like the black or white loan. Either you qualify or you don't, right? And there's no like gray areas with conventional financing. With other loan options like FHA, VA, USDA, there's all these gray areas that it helps people qualify or don't qualify, or there's some room for interpretation. Conventional financing is like, well, here's this, right? X, Y, and Z, and you're going to get a house. Here's the rule. It's just really plain and simple. So it's a simpler model when we're looking at a quick estimate for someone qualifying. So Ashley, so at $300,000, let's say someone's probably buying a condo, right, in Snohomish County.
Yeah,
right?
It would have to be a condo. I mean, you can't really buy can't buy a house for $300,000 anymore.
What do you think is the bare minimum to even find a home in Snohomish County? If you're looking at a single family home versus condo?
Oh, wow. I mean, I think you're going to have to at least be in the $4s.
Between 4 and 450, just minimum.
Yeah, minimum, right? Typically those houses need work. So it's not like a move-in ready home. It's like a house that needs probably like everything: roof, kitchen, bathrooms. Yeah, it's basically a fixer.
Yeah. Yep. Agreed. So let's say they bought a $300,000 condo, yep, and they used, they were a first-time home buyer, so they're allowed to put 3% down. Okay. And we're making assumptions that they have really great 740 plus credit.
Excellent credit.
Right. Yeah. And they are like A++ first-time home buyer.
Debt free.
So,
yeah.
So yeah, exactly. And loan amount, if they were to put 3% down, would be $291. Okay. Based off of this, right? If we were looking at an estimated average on a principal and interest payment that they were A++ credit, 740 plus, they were looking at probably maybe about a 1246 principal and interest. Right. You took an assumption, Ashley, taxes on a condo are typically less, right? Because all the units are splitting up, right, per how big they are, the estimated taxes for the whole complex, right, and they're breaking it down per unit. So $2,400 a year would be fairly fair to say. Homeowners insurance is not always required. And here's why. The condo may already cover insurance for the unit. So if it were to burn down, you just may need something for your own personal belongings to be covered by insurance.
Yes. So it could be pretty inexpensive.
So yeah, maybe $30, $360 a year. Yeah. Mortgage insurance would be roughly, again, excellent credit, about $97. You would be looking at a total payment of about $1,923. So if we round it up and called it $2,000 for number of purposes, right?
Right.
Somebody who would need to qualify for this. So conventional financing allows somebody to qualify up to 50% of their total gross income. Yes. That means, and that if we were to break that down on a monthly perspective, this would be about $4,000 a month or $48,000 a year that you would need to make. Now, the higher you go on your overall debt to income at 50%, is a tougher approval, but Fannie Mae and Freddie Mac, which is conventional financing, allows for you to go that high.
Yes.
So we could say if someone had zero debt and they pay off their credit card every month, no money, right? Really, really excellent first-time home buyer. They can make at minimum about $4,000 a month or about $48,000 a year.
And swing it. It would be tight though.
Yep, we're helping a family right now that's kind of in this situation. They're just buying a first-time home buyer condo, like a 2-bed, 1-bath. And this is like perfect. I mean, they'll probably rent out a room, maybe long-term. This is kind of to get their foot in the door because they got to live somewhere and they're already paying $2,500 a month, right? So like this, they can build some equity, get to pay down their mortgage, and they get some additional write-offs within a year, depending on what their CPA says, by owning a home rather than renting.
Yep. So it's a great scenario for that.
So let's just say we were to look at another first-time home buyer. Maybe this family is a little bit more well-established. They make a little bit more money, and they really want to buy a home and not a condo. $500,000, I would say that's fair. That's probably a step up from a fixer, right? Maybe it doesn't have all the bells and whistles, but it's definitely a step up. And so if they were to buy a $500,000 home, 3% down, it'd be about $485 loan amount. This would be a principal and interest. Again, if they have a 740 plus credit score, this would be an average, but just shy of about $2,100 a month. Taxes would be about $350 per month. And HOI, which is homeowners insurance. So if this place were to burn down or there are major issues, insurance would step in and fix that. That'd be about $75 a month. Mortgage insurance, about $160, $162. This would be all in about $2,065 a month. $2,665, I apologize, a month. And that would mean what, Ashley? What we just
calculated out. Yeah, we figured that they would
be about $5,200, $5,300 a month.
Yep, and then they need to make like $64,000 a year total.
Yeah. So, and we're rounding up with some of these numbers. Again, this is 50% of your qualifying income, and we're using the gross amount. So we're not even talking about net. So if someone were to make $5,300, probably taking down 45 home. Depending on their tax bracket, right?
Yep.
And then that means 2665. I mean, there's little. I mean, it makes it really tight, but it's doable. I mean, technically, these are the numbers and what the rules allow.
Yeah, it is tight because at 2665, that means you're going to spend basically 32,000 on housing a year.
About half.
Yeah. So it's like
of your gross
in that. And then you have to pay taxes on that whole entire 64,000. You still got to buy your groceries, it's fairly tight.
It is. It's very tight.
But doable. But you can do it. So 64.
So let's look at 800,000 for example. So a family a little bit more well-established needs something bigger because the family's bigger. Maybe they're buying more inside the city and less rural. 800,000 would be fair. Because they've crossed the loan limit of 625,000, which the county loan limit for 2022 is 625. They get pushed into something called a high balance category. High balance hasn't released what their new limits are. So right now, the limit for 2021 is 776,250 for the loan amount. So at minimum, when they go above 625, they have to put 5% down. They're not allowed to do 3% anymore.
Right.
So minimum down is 5%. Loan amount would be about 760 off $800,000 purchase price with 5% down. Principal and interest, again, 740 plus credit, really excellent. And this would kind of be a breakdown with taxes at $500, HOI 80, mortgage insurance about 253 minimum, and total payments about 4,089.
Yep.
So that means someone would need at minimum about $8,200 a month, or if we were to round up, say that's about $100,000 a year to buy an $800,000 home.
Correct. Yep. Bare minimum.
Bare minimum.
And I love this. I love these scenarios. It gives people a good idea. So I mean, just to kind of reiterate something that you said earlier on, Tyler, if you do have additional debt it does mean that you'd have to make more than these minimum amounts that we're talking about,
Yeah,
right?
because remember, we're using a percentage, right? So let's say you made $1,000 a month, and that was your income, and you're allowed to use 50% of your income to qualify. That's only $500 you get qualifying, right? So yeah, if someone has $250 minimum payment,
right,
that's going to hurt their numbers, right? We're gonna have to work that backwards and move down that qualifying number. But if someone really had zero debt, then this is what the figures would look like for them.
Yeah, it'd be great. But yeah, so yeah, I think like understanding the assumptions. It's like no car payments, no whatever, I don't know, Lowe's credit card account.
Look at this. Just to get into the market, you need to make about $50,000 a year just to buy a condo, okay, minimum. And then if you want to get like a single family home for you and a family, then you might be looking at about 64,000 we came up with.
Right.
If you're looking for a little bit larger home, you're going to need to make about $100,000 a year minimum.
Yeah. Well, and it's not even necessarily a larger home, because we were looking at the average sales prices, and in Snohomish County last month, the average sale price was $751,000. And that's just an average number.
Yeah.
It's like, whoo. And then up in North Everett, the average number is 573,000. So just to get like a run of the mill house. I mean, we're really not talking about anything special here.
Yep, I agree. And really the reality for families is this: it's expensive. But like the conversation I told you, Ashley, was what we told a family that just bought with us about a year and a half ago. They bought right in the middle of COVID, have a tremendous amount of equity in their home. Right. And they realized after a year, they thought they would be able to be there, and they need to upgrade. I mean, they need more room. They're planning on growing their family. And how do they do that? It's like, well, you better move now before prices go up even more, right? So you end up selling, cash out, take the money, buy the new house, and move forward.
Well, and that's the thing. I mean, that's the thing that people are always working against. You're working against two things, right? You're working against the annual appreciation and then the rates. Man, it's like both of them. You get double hit, because it's like things are going up double-digit percentages. You go from 573, if that increases 10% the next year, that's another almost $60,000. I mean, it takes it well over into $600,000 for the average purchase price.
Yeah. And I think the cost of waiting is so drastic, drastic. I think families don't really realize that the misconception is 20% down. We just looked at 3%, 5% down options. Yeah. And if families do not figure out how to buy a home now or very quickly, they will be priced out and be forced to be a renter their whole life, or be forced to move out of state, which a lot of families have had to move out of state, move to Arizona, move to New Mexico, different parts of the Midwest where homes are more affordable. But then they take a big pay cut by doing that in a lot of these areas.
Yeah, well, and you and I know those families. I think about them. I was thinking about some of them today. I was like, man, gosh, I wish they would have bought a house like 3 years ago. Oh my God, they would be like, it would have been a complete game changer. For them.
I just remember this is a really sweet family. I call them the Smiths. They were really wrestling about paying $315 for a home about 2.5 years ago. And they just said, no, we're going to wait until prices go down. And it's like, man, I still talk to the real estate agent about this family to this day. And it's like, they're still waiting. If you call them, you're still waiting for the market to go down. And that same home that they looked at, we pulled up the number, it was $550 online. Yeah. It had resold. Only 2.5 years there, $550. Yeah. Like, you're talking about $235,000 more.
Yeah. I mean, here's the thing. It's very difficult. It's practically impossible to time the market. You can never really figure out like when to get in, when to get out, and all that stuff. But it is, I have those families. I have them. I have like a list of them where it's like, gosh, they should have just bought anything. You could have bought anything, because if you sold it today, you would have made money on it.
Sure. We had one family that bought in a really scary part of COVID, and they made a decision to move forward. Bought their home about 5.25. Okay. And they came back 8 months later, and they wanted to refinance. Rates had dropped. Right. And they said, hey, does it make sense for us? they had an appraisal done and their home appraised for almost 700,000
Wow.
8 months later.
Yeah.
Because we had this big spike, right? Yes. And even if we said, look, most families aren't going to experience this maybe down the road, double digit appreciations or whatever else, right? Maybe it was just timing. People say they got lucky.
Right.
I think people have been saying that all these families have been getting lucky the last like 5 years. I don't know how necessarily we'll see a big stop. Even if prices stop today and we see a big increase in interest rates here coming up around the corner, it would force these families that would be able to buy at 500, force them down to only buy at 400. Exactly. Because they wouldn't be able to afford it anymore. And they might have to be a permanent renter.
That's the next video we should do. We should actually like run those scenarios and just show people kind of like, hey, if rates do this, if they go up 1% or they go up 0.5%, this is what happens to your buying power. Because I think it's very difficult for people to kind of wrap their heads around that. And
yeah, and I think this, I've seen a lot of ups and downs over my career of rates really dipping into the sixes. There's a period when they dipped into sixes and they came all the way down into the low twos, right? Somewhere in the middle. All the families that have chosen to buy, and they just made the decision as it was comfortable. And some of them even pushed themselves out of their comfort zone, have benefited greatly. And I think people have to realize that the first move that you have to take is they have to give us a call. They have to get pre-approved. They have to see if it's just possible. And it may not be, and that's okay for these families. Right. But I think people have to start taking the step forward in that direction. You can't afford to live in a very expensive state. You can't, I think even along the West Coast, if you live on the West Coast or East Coast, they're the most expensive areas in the entire US. And the only way to make it affordable is to control the housing payment. That way you can say, hey, do I need to get a second job? Do we need to find a job that pays more? Right. So I'm really excited that we did this video today. And you're right. I think maybe this next one down the road, if we decide to do it, is, hey, what's the cost of waiting if we go up 1%?
Yeah. I think we should. And you know, I think that video is important because, you know, there's no real indication of prices coming down. Like, you know, even if rates went up to slow the market down, right? You also have to have the price go down too, right? And it's like the price is not going to go down enough to make any sense. I mean, $10,000 is not going to matter for you.
And even I think there could be a pullback. And like everybody would say, even if there was a pullback, how could it be pullback of 30, 40, 50%?
Yeah, it's not. It's going to, and you know, people are worried about these foreclosure houses coming on.
Not enough.
Like, you know what it is? Those foreclosure houses are just going to like throw flame. It's just like going to put like lighter fluid on this.
Here's, you know? And I'll say this, because I think this will be a really good point to for all these families to really wrap this video around, is say this, is that everyone plans on these foreclosures to hit this market. What everyone has to realize is this: the servicers are so much more savvy this time around than they were in 08, 09. They weren't willing to negotiate with these families because they did so many bad loans. Right. A lot of really bad and corrupt mortgage companies and lenders that were in the marketplace. So they weren't willing to negotiate. They really just wanted their money. When we went through COVID, these servicers were making unbelievable deals to help these families stay in their homes and really, really make sure that these homes didn't go to foreclosure, and really worked with families for the first time in history. This is the first time in history they worked with so many families to really make sure. I think what people have to realize, there's not as many of these homes going to hit the market as they're expecting. Yep. And I think the only way for them to rush out and buy a home is they got to call us. And they got to email us. They got to call you. They got to get set up on a home search. Exactly. They need to get out there and decide to buy now while they still can before homes jump all the way up to an astronomical price. And for some families, the prices are already astronomical.
Yep. Well, and I think that's the point, right? Like if they're not in a position to pull the trigger when they see the deal, then they're going to miss it because it's going to be going too fast. Like this market is moving too fast. Houses will continue selling in 5 days, you know? And so if you're not already pre-approved, if you're not already like ready to go, so that when the thing comes that you want arrives, then you're going to miss the opportunity. It's going to be gone.
Yep.
Someone else will get it.
Agreed. I agree. Well, thanks, Ashley. Yes, thanks for having me on to do these videos today. Yeah, absolutely. I'm excited that we did this series. I think that's our next conversation. Maybe these families really want to know what what it looks like, the cost of waiting if rates were to go up.
Yeah. And then will you please tell people how to get in touch with you?
Yeah, absolutely. And they can give us a call at 425-931-7050. That's my personal number. So you can text me, call me anytime. You'll get a response back from me. Even if it's middle of the night, I'll just text you back first thing in the morning. If you want to text me, I've had clients actually, from our videos, text me at like 12, 1 o'clock in the morning. They might be in the graveyard. They get off. They've just seen the video. So it's fine. Call me, text me. I'll get back to you at appropriate time. Or they can email us at tylerbeardteam@tylerbeardteam.com.
Rock on. Awesome. Well, thanks everybody for watching, and we'll see you again soon. Take care.
All right. Thanks.